Hello again, VV Nation. My name is Steve Chappell, Director of Trading Systems Development here at VectorVest, and I'm delighted to be your coach for this current presentation. This one's titled, How to Navigate the Bumpy Roads of the Stock Market. And boy, I think we can all certainly understand that the market has been very turbulent here as of late. A lot of geopolitical stuff going on. And so we're going to show you how to best cope with this situation, realizing that the situation may in fact persist for a little while yet, and show you a way that's going to be well suited really no matter what the market decides to do, because we're going to be picking on stocks that are really, really strong in terms of their price growth persistence. And so some of you have probably already guessed then that we're going to be talking a lot about the Comfort Index today. The Comfort Index in VectorVest is a proprietary indicator. Dr. DeLito created this many years ago. As you can see, we're going to be going all the way back to an essay that was written on November 8th, 2002. It says here, now I don't mean to imply that the Comfort Index is the holy grail. It appears, however, that it's an excellent indicator for picking stocks going forward in time. So if you're looking to smooth out a potentially bumpy ride, try utilizing the Comfort Index. And so just a quick trip over into VectorVest, we can go locate this essay, because as I reread it myself, I relearned a few things that even I had forgotten. So I think it'll be good for all of you to revisit, to just brush up, get back up to speed on how truly unique and powerful this indicator really can be, and how it's computed and what it aims to do for us. So let's go take a peek. All right, so next stop is going to be VectorVest Views. Of course, you can use your navigational calendar to get back to November 8th, 2002. And here it is, the Comfort Index. There's going to be a lot of great text in here, of course. And, it starts out where he does some discussion about something that was known as the Ulcer Index, which looks at drawdowns and persistence in its own view. And what he did was vectorize the scaling here and create a bit of a unique spin on what that Ulcer Index was really trying to accomplish. And what we're really focusing on is not, the ulcers themselves, as that name might imply, but trying to find stocks who are quite resilient. That's the main message of all this. But I do think it's a great read. I'm not going to read it, to everyone verbatim, word for word. But it's a worthy article to read indeed. All right, so let's jump over back into Stock Viewer. We'll look at how some of the current top Comfort Index stocks stack up, and go back then and see how some of these stocks have performed this year, incorporating a bit of market timing to make sure that we stay on the right side of the market as best we can as well, realizing that these stocks can persist through some turbulence, but at some point in confirmed down situations, likely your best alternative is to simply go to cash to wait for the next opportunity. And you can kick the pants off of just buying treasuries by doing this model that we're going to be talking about here today. So let's do it. I think it's a timely one and worth discussing. All right, so let's get over into Stock Viewer. When we come here, of course, the default sort traditionally is going to be VST. Click the wrong column heading there. Just a sec. And of course, that's always a great place to start in looking for stocks that have the best combinations of value, safety, and timing. But when we talk about market turbulence, we're going to use a unique indicator here called CI, again, Comfort Index. And the charts are going to speak for themselves. So, largely, we're just going to lean on the charts as the best description. Price growth persistence is the easiest way you can do it in words. If you're like me, I like to see the picture, right? So we're going to take a look at a few pictures here. And what I'll do is just simply graph up the top however many stocks and see what we got. So this is, again, current, right? So we expect to see steady, resilient price is the aim here. So what we'll do is graph them. And when we do, well, I think that's what we're latching on to. But look at this chart. This is Abercrombie and Fitch. Retail has remained very resilient itself, and this has been one of the bigger benefactors in that space is Abercrombie. And you can see a lower left, upper right chart pattern, fairly steady along the way, realizing, hey, if you contrast that with the stock market's going inverse of the direction of this particular equity, right? We look to the bottom here and we see, boy, look at that earnings. It's just on fire, even on a forward basis. And so there's a lot of gas in the tank here on this one. So we really prefer, if we were going to go about cherry picking, stocks that look almost mirror to this. The smoother and steadier the upward price direction, and the smoother and steadier, if not explosiveness, of the EPS, the better. So we've got a pretty textbook looking stock here, realizing almost nothing moves up every single day, right? So that's what we're shooting for. And let's see if we can find anything that looks maybe even better. So we'll just go down the list. I would say that Vista Energy, this is one I'm very familiar with, one I own, one we've been talking a lot about in the Jockey Club, and we own there. And with oil and the Middle East situation and everything that's going on geopolitically, still could be some pretty good tailwind here potentially, right? But just with the elevated crude prices and such that already exist, these companies are absolutely printing money when oil is over $60 a barrel. But we look at that. The chart speaks for itself. Let's forget about all of the commentary. I've got an expression that I've always carried with me, and that is, charts don't lie, people do, And so just look at the chart. Chart speaks for itself. Come down here to the bottom. We'll stick with the facts, man. And that is earnings. Here again, not only smooth and steady, but also explosive at times, and even here recently. So could be some pretty good price explosion, at least potentially on the way for Vista Energy. Does seem like a lot of traders are getting in there and fiddling with stocks a little bit these days. But man, even with some of that added volatility, it's been a solid stock. If we look at this one here, has begun to break down a bit, right? So I would expect with the earnings that you see here, if the stock market could right itself, this likely would still be a stock that you'd want to strongly consider. It's not in one of the better spaces in the stock market right now, and I think that's what's finally sort of made this stock succumb to the stock market declines that are certainly persisting in the stock market these days. So, if it were in a better space, you'd probably see the chart continuing on just like we're seeing with some of the better geopolitical arenas in the stock market right now, like crude, like uranium, like some of these, other things that are a little bit more relevant to the current time. But building construction has been one of the more resilient spaces in the stock market. And then, of course, Sterling Infrastructure has certainly been one of the better performing stocks in that whole space. And so you can just kind of go down the list here. Boy, look at that Daktronics. I mean, that is a beautiful, beautiful price chart. And, it's kind of gone through a bit of consolidation here. It looks like, boy, I tell you, if it can just start to clip out $10 there, it's moving up again, and you got a lot of juice in the tank down there on the bottom. And so that's the idea. The smoother and steadier the upward price direction, the more we're going to like it. And then if we can get rising earnings, that's better. If we can get smooth, steady rising earnings, even better yet. If we can get rising earnings that are exploding, probably the best overall situation that you could ask for. Okay, so lots of good ones. And boy, I tell you, you're seeing a theme continue to pop up here with petroleum, with that Tidewater. Here's a chemical plastics company. But the main message here, look at these persistence of the stock price patterns in what has been, in many ways, kind of a horrific market environment for a lot of other types of stocks that are out there, particularly growth stocks. All right, so with all this information in tow, let's then close up the chart here. And let's make sure that we never forget about market direction, because the name of the game is to buy low and sell high, not buy high and sell lower. So you're best off always beginning at a market low point when making these decisions. So the encouraging thing that we can focus on right now is that the market has pulled back significantly already. And while there's still a lot of geopolitical concerns out there, a bounce is bound to happen at some stage. But how much bounce is good enough for me to want to take some risk again, right? Realizing we might get an even better opportunity later on, right? But when do I want to start nibbling at even some of these best, most resilient stocks that are out there with the highest potential for success? So if I come up to the top, go to timing, market timing graph, here's the market declines we're speaking about, of course. And of course, you can see still dipping off even today, right? But at some stage, the market will find a floor and begin to move up again. So how do we identify the low with enough accuracy to feel good about the fact that that low is likely to grab and we have some strong potential for further upside, right? So one of the best things, certainly something I've been focusing on at workshops and any venue that I'm in front of customers right now, because I've seen it over time, is the GLB RT kicker. All right. And so let's just take this year as a quick example. And I'll probably go back a little further as well, because no matter how far you go back, the story is still the same. And that is, eventually a market's going to tip over enough to where you get a confirmed down call. And when you do, I want you to start thinking of that as future opportunity, right? To get into some great stocks and capitalize on the next stock market run. And the best way to do that is going to be with this first green triangle. And you can see it's not right at the low. We're not trying to bottom fish or nail a market bottom here. We're looking for a market to steady itself and begin to actually move up enough to constitute enough strength to feel good that it can persist over time. And sometimes we'll get a quick reset and yet another opportunity to do another campaign. Right? But notice the reds, they're going to get you out of harm's way when the market turns really super nasty. And they're going to do a good job of that time and time again. And the first green lights are going to have, or confirmed green lights in this case, are going to have the highest profit potential, right? There's always going to be a first confirmed green light, for example, and a last. That's another concept that Dr. DeLito has stressed to us in our newsletter, right? In the VectorVest Views, in that don't treat these things with impunity. We want to get out of harm's way as quickly and efficiently as possible without being too overreactive, particularly with resilient stocks. But at the same time, we want to really focus on buying low when we reinstitute buying some of these stocks again in the future. And so what you're going to be waiting for now is that first green triangle, which we do not have yet. And just judging by the shape of things here, realizing that a green light requires the price of the VectorVest composite to go higher week over week for 2 weeks, and that's just the green light, right? But then also the relative timing moving averages are going to have, or momentum is going to have to confirm that's usually not the very first green light, folks. So it's going to take a couple of green lights usually, if not a few, before you start to get confirming ones. And so let me show you here quick. Probably a better example is going to be if we go back in time here just a bit and work forward, just to give you the best picture possible, okay? So let me go back even further here, actually. But you can see with each one, there's going to be a confirmed down, get out of harm's way, and there's going to be an early green light. Boy, look at the early green lights here on all of these runs, right? And what it's going to also do, as I zoom in across here, we'll take a more normalized market approach, not a black swan event. If I come down here to the bottom and instead of using GLB RT kicker for only the confirmed greens, watch what happens if I just use green lights alone, okay? So if we go to green light buyer, we're going to have some green lights here in the middle that could get you into a little bit of a pickle if you're not careful. Now, a good chart reader may have avoided some of these buying opportunities as they quickly move to neutrals and prices did not run higher. But just to totally take that out of the equation and make things as simple as possible, right? If we come back here to the bottom, let's do the eye test again. Watch these green lights here in the middle, okay? Gone. Also notice a lot of the green lights that were up here when markets were higher have also disappeared. So it tries to minimize green lights at the top and premature green lights before you even get to the actual bottom. And by doing that, it's going to really take your stress level down because you're going to feel better about the ones that you're choosing at all times, realizing you're never going to get anything that is 100% perfect. This is as close as I think you'll get in VectorVest from what I have seen over my 22 years. Okay, so that's the idea here. And when we talk about confirmed green lights, of course, you can just come into this market timing graph and wait until you get the green triangle at a close. Make sure the market's moving up the next day and then look to buy some of those high CI stocks, okay? Right from Stock Viewer. Now, if we did that, what would some of the results have been recently to give me a little bit more comfort that when it happens again here in the future, that even if the markets don't behave as well as I would hope, right? Or if they get on a big run, what's kind of the experience here? I'm going to show you some quick tests over the last year. I'm also going to show you some longer term evidence that this is in fact a really good strategy, no matter what the future market might bring. Okay. So let's remember some of these dates just for now to try to solidify the concept. After a confirmed down, we're going to look for a buying opportunity on the first confirmed green light. So 4.3 up to 7.6 would be a campaign. We would shut that campaign down. You didn't know the market was going to reverse. It did. We got another confirmed green light early because of that. And we can do another campaign until we get to, I think, 8.9. Okay. And now we're still waiting for the next. There was also another earlier campaign on this window from 1.9 all the way up to 2.21 is going to be that date. Okay, so 3 campaigns so far this year. Could be another one yet to come, which would be 4, should that happen. Okay, and then we'll go back and look at more. But for now, let's just focus on these. So we're going to start with 1.9 and run a campaign of we'll just blindly take, without even cherry picking, looking for the better chart patterns, doing all those kinds of things, just blindly take really resilient stocks, see how they did. All right, so I'm going to come over here into viewers. And when we do that, we just simply take the date back. That's one of the beautiful things about VectorVest, actually, is you can go back and do a little research for those that are interested and want to and willing to do that. If not, you just watch these special presentations, right? But the idea here is we're not sorted by VST, we're sorted by CI. So these were some of the strongest chart patterns back then. Let's just look at the top 10. All right. Yep, that CPRX got hit. So that's going to sway some of the result here because we're not doing any management, whatsoever. Now, I will say this, and you're going to see evidence for it here in a bit. Generally speaking, these stocks are of such great quality that managing them becomes difficult because just as soon as you cut one, it rebounds and starts going higher again. Now, if you own a stock and you get news that the pharmaceutical recipe that has been provided, making lots of money for a company, all of a sudden has been turned into an over-the-counter medication for another company, you might then say, well, I'm going to go ahead and cut the cord with a stock, right? That would be the smart thing to do. So we're not taking any of those kinds of things into the calculus here. Now, these have been resilient all year. What if we just go back to 221. So we're on about a 29% annualized rate of return at this point. If we go back to 221, that was the confirmed down call that we saw on the chart, right? Now the returns go down, but it's only a little over a month campaign here. Well, nearly 2 months, I guess. But 11%, that's 94% annualized. That's going to help in this case, to some respect by happenstance, mitigate some losses here. But look with HRNG. See, we talked about how these stocks are resilient. That one was actually on a gain, I believe, all the way to current. Whereas here, it had taken a little bit of a spill. So there's lots of messages here that I'm trying to help you work through. The main message, these stocks are up 11% in about 7 weeks, looks like. That's 94% a year. VectorVest Composite, the average stock in the stock market was up 3 1/3. Okay, so you're doing, roughly 3 times, almost 4 times performance here, between 3 and 4. Okay, now if we go to the next one, remember that next low point in the stock market was 4.3. And here's the cool thing. When we go to 4.3, it's not going to be those same stocks, right? In this case, it's NVIDIA, looks like with a little bit of leverage. ELF, which has been a terrific stock in the stock market this year, and so on down the list. Now, TRMD was the highest ranked CI stock back on January 9. It's falling down the list here a bit. But let's see how this list does, just the top 10. All right, and so the top 10 all the way to now are still up 15%. So we're talking about the resiliency of these stocks here again, particularly when we're able to buy them low. This is not a insignificant message, okay? With these kinds of stocks, if we're able to buy low, it's going to give you a high probability for success, is the message. Then, if we can use even a little bit more intuition to our advantage, we can stack that earlier 11% on the 7-week run with, this is going to be about a 3-month run in these stocks into July, right? So the next confirmed down was July the 6th. And now you've stacked another 11%. Okay, so that's 22% so far for the year. Slippage to be sure somewhere, right? Don't miss the message for the nuances, right? We're talking about potential. So I did run that for you. We may consider creating some trading systems from this. But for now, just really wanted to pass along the message. And that is, with no stops and that same methodology, starting from the COVID low to where we are now, okay, 60% of the stocks were winners. This is with no management, no stops. 210% gain over that period. That's 59% annualized rate of return. And so I assure you that this is beating the pants off of not only treasuries and things of that nature, certainly, et cetera, that it's absolutely stellar returns in general, right? Now, it does come with a bit of high drawdown. Remember, these stocks, even as resilient as they are, can have some pullbacks of some consequence. But they tend to persist and sometimes go even higher in the future on the back of that. So the whole message here is, don't get too cute with stops. You start throwing tight stops on these things and your performance is going to continue to deteriorate. About the best that I could come up with, at least in short order, was a 20% trailing stop off the intraday highs, right? And when we do that, it's 165%. So we do give away some performance factor here. It does mitigate some of that drawdown. Now, I've even heard Charlie Munger, right, describe to folks in meetings and things that he's had experiences of 50% drawdowns in his Berkshire portfolio 3 times, But those things are hard to stomach, ladies and gentlemen. 32% is hard for a lot of folks. Now, you may not be one of those folks, right? But odds are you are. And there's a big difference, believe it or not, between a 32 and a 22. And so you're still doing 46% a year roughly, and your drawdown is less than half. So that's pretty significant. But let's not get too far into the weeds here, because what we're saying is if you wanted to take a hands-off approach to the stock market and literally just focus on, do I have a confirmed green light after a confirmed down? Okay, I do. Let's get into stock viewer, sort by CI, and buy some stocks. And if that's merely all I do, give myself a high probability of success, that's what you saw today. If I want to manage my emotions a little bit better and put some stops on here for peace of mind and other factors like actually mitigating some drawdown, let's do it. Let's just not get too cute and carry tight stops here. Let's make sure we give these stocks a bit of a wider berth and give them every opportunity to run. And so I hope you enjoyed this presentation. We're going to keep it short and sweet today. And we'll see you again here soon. Thanks for tuning in, guys. Look for those high CI stocks, but remember, let's wait for the next confirmed green light before pursuing this kind of a methodology here. We'll see you soon. Good luck.